A guide to equity release and lifetime mortgages. Hi, if we haven't met before, my name is Dan and I'm a CMAP qualified mortgage and protection advisor. This video is purely for educational purposes only and should not be seen as advice or a recommendation to act. I must stress that I'm not a qualified equity release advisor, but I will provide contact details to my colleague who is at the end of this video. So equity release and lifetime mortgages are a subject that not many people know about. The idea of this video is to cover this topic and squash any myths that you may have heard. As there is a lot of information to take in, I provided a link in the description to the presentation that contains all of this helpful information. So what is a lifetime mortgage? A lifetime mortgage is a loan secured against your home which does not need to be repaid until you die or go into a long-term care. In the case of more than one borrower, the mortgage is not repayable until the last borrower dies or goes into long-term care. A lifetime mortgage frees up some of the wealth you have tied up in your home and you can still continue to live there. Traditionally, you do not need to make monthly payments on a lifetime mortgage as interest is added monthly and it is repaid on the sale of the property. This is commonly known as rolled up interest. Lifetime mortgages have evolved dramatically over the last few years. There are many features available, including the ability to service the monthly interest, make capital repayments, and have a drawdown facilities for future borrowing needs. Speak to a financial advisor that specialises in equity release and lifetime mortgages for further information. At the end of this video, I have left my colleagues' contact details who will be able to assist you. What do clients use lifetime mortgages for? As you can see from this slide, the main use for a lifetime mortgage is either to clear their outstanding mortgage and or carry out home and garden improvements. There are other uses such as clearing unsecured debts, paying towards a holiday, top up on day-to-day living, supporting loved ones and buying a new car or caravan. So are you eligible for a lifetime mortgage? To be eligible for a lifetime mortgage, you will need to meet some key requirements. The most basics are you must own a property, you must be a UK resident, you must be 55 years of age or older, your property must be in England, Scotland or Wales, and your property must be your main residence. The other requirements relate to your personal circumstances and your property. Some restrictions may apply over the type of property you own. So how much can you borrow? The amount you can borrow depends on your circumstances, which include your age and the value of your property. If there are two of you borrowing together, the amount available would depend on the age of the younger borrower. In order to gain an accurate value of your property, an independent valuation will be undertaken by a qualified surveyor. There are things to consider. There are various reasons why people access equity in their property. Some use it to top up their pension, others help pay off their mortgage, and some use it as a gift as a lump sum to children or grandchildren and help them onto the property ladder. Whatever your reason for considering a lifetime mortgage, it is a long-term commitment and is not something that you should be rushed into. Alternative options may be better suited, such as downsizing, paid work or utilising other savings or investments. Before you apply for a lifetime mortgage, we recommend you discuss it with your family. Your tax position, entitlement to means-tested benefits and the amount of inheritance left to friends and family may be affected and are all subject to change in the future. There are a number of equity release products with differing features and benefits that could help you mitigate any risks. You would need to discuss how a particular product meets your needs and preferences with your financial advisor. As with all financial products, there are risks as well as benefits. So what are the benefits and risks to a lifetime mortgage? Some of the benefits include you retain ownership of your home and you can stay in it for the rest of your life. The money released is tax-free and you will never owe more than the value of your home. As we are members of the Equity Release Council, we only recommend products that offer a no negative equity guarantee. Some of the risks are your entitlement to state benefits and grants may be affected if you take out a lifetime mortgage. A lifetime mortgage may be more expensive than selling your home in the long run. The size of your estate will reduce. A lifetime mortgage is a significant financial decision. It is not for short-term financial needs. So how much does it cost? When you take out a lifetime mortgage, there are some costs involved. The main charges are a valuation fee, This covers the cost of valuing your property and is payable when the application is submitted. In some cases, the equity release provider will cover this cost. A completion fee. This is paid upon completion of your lifetime mortgage. You can usually pay this at the point of completion or add it to the mortgage. Solicitor fee. You'll need to instruct a solicitor to deal with the lender and registering your lifetime mortgage at Land Registry. An advisor fee. You may be charged for advice by your financial advisor. There's an early repayment charge. The loan may be repaid in full or in any part at any time. As a lifetime mortgage is designed to last for the rest of your life, there may be a charge if the loan is repaid earlier. So who is involved in the process? Family and friends. We always recommend you discuss your plans with family and friends. They will give their opinions, advice and support you throughout the process. A financial advisor. Your advisor will help decide whether equity release is suitable, recommend an appropriate product and help you navigate through the application process. The lender. The lender is the company that will provide you the mortgage. The valuer. The valuer is instructed by the lender to determine your property value. The valuer is independent, so not biased, and they will send the report directly to the lender. The lender solicitor. The lender will instruct the solicitor to act upon their behalf. They will make sure all of the paperwork is completed correctly and register the mortgage at Land Registry. And last but not least, the client's solicitor. Your solicitor will act on your behalf, whom you will need to meet face to face to understand the terms of the contract. Your solicitor will liaise with the lender solicitors up until completion. So what is the process? Research. Before taking out an equity release product, you should research all your options to check equity release is the right choice. Talk to your family. We recommend discussing your decision with family as it could affect them. Talk to a financial advisor. Equity release products have to be recommended by a qualified financial advisor. If they decide it is the right product for you, they will provide you with a key facts illustration which explains the important details and costs. Complete an application form. Your financial advisor will help you with this. Have your property valued. An independent valuer will make contact to arrange a convenient time to visit to carry out a valuation. Appoint a solicitor. You will need to appoint a solicitor to complete the mortgage. Your financial advisor should be able to recommend a reputable company. The lender makes an offer. Following the valuation, the lender will confirm the amount of borrowing and send an offer letter to you, your financial advisor and your solicitor. The legal process. Your solicitor will provide you with independent legal advice, talk you through the conditions of the contract and have you sign a mortgage deed. The solicitor will also complete a certificate to confirm the features and implications of the contract have been explained to you. The cash is released. Once the lender has received all required documentation, they will release the money to your solicitor. So what are the common features of a lifetime mortgage? Moving home option. Some providers allow you to move home and take the lifetime mortgage with you, avoiding earlier repayment charges. If the new property is valued lower, you may have to repay back part of the mortgage. Cash reserve facilities. Some products have the option to have a pre-approved cash reserve facility for future borrowing needs. No additional financial advice is required in most cases, as the facility is set up at the outset and the advice has been given at that point. Option to make interest and or capital payments. Some products have the option to pay all or some of the interest each month. This gives you greater control over whether your mortgage balance increases or remains at its original amount. A further option may allow you to make capital repayments towards the mortgage and reduce the debt. Fixed interest rates. The majority of lifetime mortgages have fixed interest rates for the duration of the loan. If you take out additional borrowing or draw down against a cash reserve facility, the rate will also be fixed for the duration, but it will be determined by the prevailing rate at the time you apply for the additional borrowing or drawdown. Repayment of the loan. The loan rolled up interest and charges are usually paid on sale of the property when you, or the last surviving borrower, die or move into long-term care. Your beneficiaries can retain ownership of the property by repaying your lifetime mortgage from their own resources or a new mortgage in their own names. And no negative equity guarantee. Most lifetime mortgages offer a no negative equity guarantee. This means when the property is sold, if your proceeds are not enough to pay the amount owed, including the estate agent and solicitor fees, you or your beneficiaries will not be asked to pay the shortfall. Any residual amount belongs to you or your beneficiaries. Optional inheritance guarantee. Some products allow you to protect a percentage of your property value from the outset. The percentage protected is guaranteed to be available on the sale of the property to you or your beneficiaries. Early repayment waiver. Some providers offer a waiver which means that in the case of joint borrowers, an early repayment charge will not be payable if you decide to repay the mortgage in the first few years of the first borrower dying or going into long-term care. Downsizing protection. Some products offer downsizing protection, which means you're able to repay the mortgage without penalty if you're moving to a smaller property. Retained ownership. As long as the terms and conditions of the mortgage are adhered to, you will always retain ownership, have control over and be responsible for maintaining your property. No repossession. As long as you adhere to the terms and conditions of the mortgage, you are able to remain in the property until you die or go into long-term care. This applies even if the rolled up interest exceeds the value of your property. So what are the equity release myths? You've got fear of losing control and ownership of their home. Misconception that equity release means no inheritance. You have the perception that it's an expensive product. There's concerns that the debt will be passed on to their estate. There's lack of awareness about what equity release is, and quite a few people have heard scare stories. For more information, please contact my colleague Sam Clark. His details are on the screen. Watch this video for differences between income protection and accident, sickness and unemployment. And if you want to know how to improve your credit score, watch this video. If you found this video helpful, please give it a like. And if you subscribe, you'll be notified of any new content I do. Thanks for watching.